Hi everybody, I'm Tom Choisnet, enrolled agent. I've been doing taxes for over 50 years and I thought it was about time with the passage of the new Tax Cut and Jobs Act to tell everybody a little bit about what's really going on. You see, the Tax Cut and Jobs Act was put together in a period of I think 7 or 8 weeks, whereas the Tax Act of 1986 took 2 years. There's something not quite right about it, and it's actually set up to expire at the end of 2025. So that said, let's take a little look with a disclaimer here I have so that you can understand that this is primarily an educational video to put ideas forward that you can use when you're working with your own research and your own tax professional. Now, I, like most tax professionals, we kind of figured that it's going to be beneficial. You're going to have lower taxes, you're going to have higher standard deductions, you're going to have all kinds of really great things. Then you start looking at it and you see, oh no, there aren't going to be any more miscellaneous deductions. Well, the tax public is pretty abusive in that area, so they're not crazy. So I think I'm going to get rid of this suit and tie. I want you to know that I'm here for you. Okay, so here's what happened. Along comes notice number 2018-76, and we get word of that, and we say, well, while the original tax law says entertainment expenses are no longer deductible, the pundits kind of looked around and said, well, wait a minute. Are they or aren't they? Well, they're not, but 2018-76 says, yeah, they are, but only to 50% and only after or before bona fide business meetings. So whatever that means. What this really does, that particular moment, gave vent to what is obvious. There's a lot of flexibility in this new law because it does run out in 2025. So let's take a little closer look at what's going on, and I'll hit the points of the things that you should know and understand, things like the SALT deductions and the higher standard deduction, the charitable contributions changes, and give you a little better understanding so you can use what's going on. And you're going to have some big surprises, particularly you carpenters out there, you truckers, and construction workers, teachers, police, firemen. Okay, well, we'll get into that. Well, we'll go in a little further. There's some ideas here I want to express, some things that are going on. Obamacare is still with us for this year, so if you're one of the unfortunate few who have to pay the penalty, you're going to have to pay the penalty again. So don't forget that, because it can be an ugly surprise down the road. Also, alimony is still deductible for this year, although it's going to be modified for 2019 and beyond. Okay, let's look a little closer. The standard deduction is going to be $12,000 for single, $25,000 for married couples filing jointly, and $18,000 for head of household. They've taken away exemptions, but in place of exemption, they give you an increased child tax credit. So it works out pretty close to the same. It's like a $4,000 exemption in the 25% tax bracket. So those credits are good and fair. If you have relatives hanging around that don't contribute, that make less than the $4,000 limit that they give you, you get $500 for them if they've been there all year. And also, the kids away from school until they're through age 23, you can deduct them as under the $500 credit that's available for them. A little perk worth noting is that the amount that you have to take off your medical expense, which has been 10% recently, has been reduced to 7.5% for 2018 to give you a little boost there. So some of you might be able to take advantage of that. The interest deduction is going to be at $750,000 mortgage limit. Most people won't hit that one, but many people have second mortgages. Many of them have what we call HELOCs, and those will no longer be deductible immediately. However, if you have a grandfathered HELOC loan and the money was in fact used to buy, build, or improve your present personal residence, that will continue to be deductible. Another area of concern is the state and local taxes deduction. That is capped at $10,000. That's going to hurt a lot of folks. In fact, if you're one of those that goes over the $10,000 because you have some investment real estate or perhaps a second home, you can capitalize those real estate taxes down the road should you sell in the future. There's one other big one. The Section 199A is a 20% reduction in taxable income for those who are self-employed, and that will apply to most taxpayers that are self-employed. Those who net over $157,500 single and double that, $315,000 for married couples, they will have to look at a different direction. Okay, let's talk a little bit about the shortcomings in the new law. As we know, there are no longer miscellaneous itemized deductions, so certain employees are going to be stuck. Quite noticeably, teachers. Teachers can only take the $250 that are a front-page deduction under the present law, and those folks usually spend more than that, and it seems inequitable that they can't deduct it. How about carpenters and mechanics? They can no longer deduct their tools. And transportation employees that by statute, that's still the law, can deduct $63 a day for their meals and incidentals. That just so happens to be a miscellaneous deduction in most cases, so they don't get the deductions at all. So I'm looking that perhaps wise employers will pay a reduced salary and reimburse those expenses directly. Some large employers like the railroads, they can't react that fast because of existing union contracts. These things will be addressed as time goes on. Gambling income, as we all know, is income, but under the new law specifically, they are allowing you to deduct the gambling casino expenses, the expenses of getting there, the expenses of producing this income, so that most reasonable gambling income will zero out. Here's another area that I think you should be concerned about, is that in the case of police, fire, and teachers, they all work for government agencies. Government agencies are a charitable deduction, so maybe in a very liberal way, part of the expenses that they can no longer deduct as miscellaneous deduction just might be deductible as charity. I'd be very, very careful on this. I would have it properly documented in accordance with the charitable laws, but I see a little possible break there. So thank you very much for watching. If you like the video, give me a like and subscribe, and we'll see what we can do down the road. Thank you very much for watching. By the way, I am a SAG actor. Look up imdb.com and search Tom Choisnet, and that should help my ranking a little bit, and I'd appreciate that. Thank you very much.